CPA Dave Young is back with us. Dave, good to see you.
Oh, it's great to be here today.
I cannot believe that our topic is mid-year tax planning. Time is flying, but it's a great time to sort of reassess where you're at. And I guess you start by looking back at last year and sort of the impacts of the new Tax Cuts and Jobs Act, right?
That's right. So we're in year 2 now. So remember, our standard deduction is much larger. We got rid of the personal exemption. The tax credit for your child went up from $1,000 up to $2,000, assuming the child's 16 or less. But there's a lot of itemized deductions that have gotten rid of. So there's no miscellaneous itemized deductions, for example. The biggie is your SALT, state and local income taxes capped at $10,000. It affects a lot of the people listening today.
Right. And so how do these changes impact how we should be, quote-unquote, tax planning?
Well, I would tell you, you would really got to look at your withholding, number one. So this is the mid-year. Look at your withholding. Make sure it's pretty close to where it needs to be. Run a tax plan with yourself or with your CPA. We saw a lot of people last year who did not have enough withholding. The tables changed, and that could have continued on this year. So if you under-withheld, you still have the time to adjust.
That caught a lot of people off guard,
A lot of people got caught off guard there. The other thing to think about is with the larger standard deduction, this is a year where you may want to bunch up your expenses, maybe take a standard this year, or pull some of your itemized deductions into this year, itemize this year, take a standard next year. So these are things to sort of think about now.
And have that conversation with the CPA.
Correct, right.
Let's talk about two things you've got on the list here, child tax credit and dependent tax credit. How are these factoring into how we are looking forward at this point?
So that child tax credit is pretty big now, up to $400,000 of income. So a lot more people will get that.
Yep.
The key is when your child turns 17, the year that child turns 17, it goes from a $2,000 credit to a $500 credit. But if you're taking care of a parent, you'll still get a $500 credit for that. So just keep that in mind, and you're going to have to give your preparer, if you use the outside preparer, proof that that child's actually your child, like a report card, because the government does not want people getting the credit that don't deserve the credit.
Right. Some other thoughts when it comes to planning ideas. You've got a number of things on the list. Let's take a look at a few of them here.
Well, the big one is your SALT deduction. So
yep.
One of the things to think about is New York State decoupled. So what we saw last year is, oh, I'm going to take a standard deduction. I don't have to keep track of all of my expenses. Well, SALT is one of them where if you have high real estate taxes, you might actually take a standard on the federal, itemize on the state. So keep that in mind. And the same thing is true for your charitable contributions. You might not have enough to itemize on the federal, but you may end up itemizing on the state. So keep that in mind. A lot of people did not keep track of all their charitable contributions because they said, oh, I'm going to take the standard deduction. True on the federal, yeah. Not so true on the state. That's the biggest thing that people really did not pay attention to last year.
Left them scrambling at tax time. You know what? Now is the time to plan ahead here at mid-year. Dave, as always, thank you.
Thank you.
Appreciate the time. If you missed any of our conversation, lots of good information there this morning. We're sharing it online, as always, at rochesterfirst.com.